What's up, future millionaires, or at least, future people who can afford avocado toast without checking their bank account 3 times. It's your favorite cynic/financial analyst back again, and today we're talking about something that gets more misinformation than a flat earthers convention, the epic showdown between flashy stock picking and the silent assassin known as index funds. Let's be real. Every other TikTok guru, YouTube expert, and your cousin's frat brother thinks they've got the secret sauce to beat the market. They'll show you screenshots of massive gains, talk about their diamond hands, and act like they're the next Warren Buffett. Spoiler alert, they're probably not. And neither are you. Oof, too soon. Nah, that's just the truth we need to unpack. Because while everyone's chasing the next meme stock high, the real money, the quiet wealth, is being built elsewhere. And it's probably not as exciting as you think. But guess what? Boring makes you rich. Exciting makes you broke. So grab your artisanal coffee, because we're about to drop some knowledge bombs that might actually save your financial future. First, let's talk about the irresistible allure of stock picking. Why do we, as a species, collectively fall for this trap? It's simple, main character syndrome. We all want to be the hero of our own financial story, the one who found that one obscure company before it blew up. The media hypes it up. You see headlines about Tesla millionaires, GameStop gladiators, and crypto cowboys. It creates serious FOMO. You think, if they can do it, why can't I? The dopamine hit of a stock going up, even a tiny bit, is addictive. It feels like you're smart, you're in control, you're playing the game. But let's rip off that rose-tinted filter, shall we? What they don't show you are the endless hours of research, the gut-wrenching volatility, the sleepless nights, and the crushing defeats. They don't tell you about the hundreds of other stocks they picked that went nowhere, or worse, evaporated entirely. They conveniently forget to mention the fees, the taxes, and the sheer amount of luck involved. Stock picking, for 99% of people, isn't a strategy, it's a glorified casino. And the house, meaning the seasoned pros, the algorithms, the insider information, always wins. You're bringing a butter knife to a tank fight, hoping your feelings about a company will somehow override decades of market data and institutional analysis. It's cute, really. But it's not smart. Now, for the cold, hard, data-backed truth about individual stock picking. You ready for this? Most active fund managers, these are the people whose entire job is to pick winning stocks, who have access to Bloomberg terminals and teams of analysts, most of them fail to beat their benchmark indexes. Year after year. The SPIVA reports from S&P Dow Jones indices are like the Grim Reaper for active management. They consistently show that a significant majority of actively managed funds underperform the S&P 500 over 5, 10, and 15-year periods. We're talking 85 to 90% failing to keep up with just buying the whole market. Think about that for a second. These are professionals, with immense resources, and they still can't reliably do it. What makes you, a person with a full-time job and a TikTok addiction, think you're going to crack the code? No offense, but statistics don't lie, even if your favorite financial influencer does. And let's not forget the hidden costs. When you're actively trading, you're racking up transaction fees, bid-ask spreads, and if you're good, or lucky, short-term capital gains taxes, which are usually higher than long-term gains. Each of these tiny cuts bleeds away your returns, making it even harder to catch up, let alone surpass, a broad market index. The finance industry wants you to trade. They make money off your activity. Your broker isn't making money when your money is sitting quietly in an index fund. They make money when you're buying and selling like a frantic squirrel. It's an illusion of control that only benefits the intermediaries. So, what's the antidote to all this noise and underperformance? Enter the underdog, the quiet kid in the back of the class who ends up running the company, the index fund. What is an index fund? Simply put, instead of trying to pick the best apples, you just buy the entire orchard. An S&P 500 index fund, for example, holds a tiny piece of all 500 of the largest publicly traded companies in the US. When you invest in it, you're essentially betting on the overall growth of the American economy, not on whether Elon Musk will tweet something regrettable next Tuesday. Why is this a financial superpower? Diversification. It's the closest thing to a free lunch in investing. By owning hundreds or even thousands of companies, you instantly mitigate the risk of any single company failing. If one company tanks, it's a tiny blip on your radar, not a catastrophic meteor strike. Think about it, if you owned only Blockbuster stock in 2005, you were toast. If you owned the entire market, Blockbuster's demise was just a small footnote in the grand scheme of things. Index funds offer instant, broad diversification at a ridiculously low cost. We're talking expense ratios of 0.03% to 0.15% per year. That's like a few bucks for every 10 grand you invest. Compare that to the 1 to 2% fees active managers charge, whether they beat the market or not. Suddenly, that seemingly small difference snowballs into hundreds of thousands, if not millions, over decades thanks to the magic of compound interest. It's literally paying less to get more, consistently. This brings us to the quiet wealth strategy. The real flex isn't showing off a risky stock pick that went up 20% one day, it's building generational wealth slowly, steadily, and stress-free. Index funds tap into the foundational principle of capitalism. The overall market tends to go up over the long term. Recessions, pandemics, wars, the market always recovers and then some. Historically, the S&P 500 has averaged returns of around 10% per year over decades. That's not sexy, that's not meme-worthy, but it's how real wealth is made. This approach aligns perfectly with behavioral economics. Index investing removes emotion from the equation. You're not checking your portfolio daily, panicking over dips, or getting greedy during highs. You're just consistently investing, often through dollar-cost averaging, DCA, which means investing a fixed amount regularly, regardless of market fluctuations. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. Over time, this averages out your cost and removes the impossible task of timing the market. Nobody can consistently time the market, I repeat, nobody. Not your guru, not your cousin, and definitely not the guy trying to sell you a course on Twitter. The goal isn't to time the market, it's time in the market. Financial freedom isn't about bragging rights or being able to say you picked the next big thing. It's about peace of mind. It's about knowing your money is working for you, quietly and efficiently, while you live your life. It's about the freedom to pursue your passions, to travel, to spend time with loved ones, without the constant stress of monitoring stock charts. It's the set it and forget it strategy that actually works. Think about it, boring leads to rich, exciting leads to stress and often, regret. Which one sounds more appealing now? So, how do you actually get started with this quiet wealth strategy? It's embarrassingly simple. Open an investment account with a reputable broker like Vanguard, Fidelity, Schwab, or even a robo-advisor like Betterment or Wealthfront. Then, you look for low-cost, broad market index funds or ETFs. Some popular ones include VOO, Vanguard S&P 500 ETF, SPY, SPDR S&P 500 ETF Trust, QQQ, Invesco QQQ Trust, tracking the Nasdaq 100, or VT, Vanguard Total World Stock ETF, if you want global diversification. Just choose one or two that fit your risk tolerance and invest consistently. Now, I can hear the rebuttals already, but what if the market crashes? My friend, a market crash is not a reason to panic, it's a reason to salivate. It's like a massive everything must go sale on assets. When the market dips, your regular investments buy more shares at a lower price. It's an opportunity, not a catastrophe, for long-term index investors. And, is it boring? Yes. Absolutely. It's incredibly boring. And that's precisely its superpower. Boring isn't a bug, it's a feature. Boring ensures you don't make emotional, knee-jerk decisions that derail your financial future. So, to wrap this up, let's get one thing straight: active stock picking is for ego, for the thrill seekers, for the people who think they can outsmart a system designed to be unoutsmartable for most individuals. Index investing, on the other hand, is for building real, sustainable, quiet wealth. It's about humility, patience, and trusting in the proven power of capitalism over the long haul. It's about understanding that the less you try to do, the more your money will actually do for you. It's not about being the loudest in the room, it's about being the smartest. And in finance, the smartest move is often the one that looks the most boring. Stop chasing the hype. Stop listening to gurus trying to sell you a dream they can't even achieve themselves. Start investing in index funds, consistently, and watch your future self thank you. Seriously. Your future self will be able to afford the fancy avocado toast and the house it's eaten in. If you learned something today, smash that like button, subscribe for more cynical wisdom, and let me know in the comments if you're ready to ditch the stock picking drama for some quiet wealth. Peace out, and go get rich, boringly.